Hello people, welcome to Figure It Out with Rajat. Today we will learn part 2 of our series Accounting Concepts and Principles, and today we will cover accounting principles. The first principle which we will cover will be a business entity principle. This principle is known by all of us. Remember, when we talk about buying phone, we say we want to buy a phone of Apple. We doesn't say that we want a phone of Steve Jobs. The reason is that we know that Steve Jobs and Apple are two different business entities. And as per business entity principle, we treat business as in a separate unit from its owner, creditors, managers, and others. Because of this principle, we charge interest on capital, and we we give interest on capital to the owners and charge interest on drawings from owner. We treat creditor of a business is a creditor of business, not a creditor of a person or a owner of a company. This is the reason why when we say a joint stock company gets liquidated, then only the assets of joint stock company is liquidated, not the assets of a owner of a company gets liquidated. For example, if Reliance Industries get liquidated, then the assets of Reliance Industries will be auctioned, but the assets of Dhirubhai family or the Ambani family will not be touched. Let's come to another concept, that is money measurement concept. Under this concept, we will record only those transactions which are measurable in terms of money. For example, if there is a quarrel between manager and employee or an employee and a consumer, these quarrels have many effect on business, but such things are not recorded. Even transactions like 4 chairs or 5 furniture, 2 fans, 3 machines are also not recorded. But the cost of these machines, for example, a purchase of machine was 40,000 will be recorded. That is what money measurement concept says. As per money measurement concept, only those transactions and events are recorded in accounting which are capable of being expressed in terms of money. Let's come to another principle, that is accounting period principle. See, if we want to know that business is performing good or not and how is it performing, we can only get when the business gets liquidated. But we have to prepare reports on an annual basis. So we divide the time period between months in 12 months. Standard time for a accounting book is 12 months. Financial activity and transactions should be reported and summarized within specific time frames, known as accounting periods. That is what accounting period principle says. Generally, the accounting year begins from 1st April to the end on 31st March of next year. Let's come to another principle, that is the principle of full disclosure. As per principle of full disclosure, all material information or all significant information related to the economic affairs of the enterprise must be disclosed. This is the reason why we see a contingent liability and contingent asset in notes to account of a balance sheet, because these are very important. The method of valuation of stock or the method of depreciation involved or the way of making provision, these all points are recorded in notes to account under the balance sheet as a footnote. Market value of investment is also given in a footnote so that we can have an idea of a true and fair view of economic position of business. Let's come to another principle, which is principle of materiality. According to this principle, only material information should be presented, not insignificant information should be presented to the users of accounting. The information which can change the mindset of or which can change the decision of the user should be presented to them. They should not be hidden by doing creative accounting or anything like that. For example, it is important to know how much money is spent on stationery as a whole, not on how much money is spent on pen, pencil, scale, rubber. This is what a principle of materiality says. According to materiality principle, items having insignificant effects or being irrelevant to the users needs not to be disclosed. Principle of conservatism or prudence. According to this principle, we anticipate all losses are recorded in the books of account, but anticipated or unrealized gains should be ignored. For example, the closing stock is valued at cost price or market value, whichever is lower. So here we are anticipating loss is recorded in the books of account, but unrealized gain or profit is not recorded in books of account. Similarly, the provision for doubtful debt is created because we know that some portion of debt will not be recoverable. So we are making provisioning of that debt. Similarly, provision for a pending lawsuit is also the same, that we are anticipating the losses into the books of account, or all anticipated losses are recorded in books of account, but all anticipated or unrealized gains should be ignored. This principle leads to the creation of secret reserves because it discloses lower profits in comparison to actual profit and discloses understatement of asset and overstatement of liabilities in comparison to actual values. Let's come to another principle, which is cost principle. As per cost principle, an asset should be recorded at the price at which it is acquired. The price of acquisition includes the cost of machine, freight, any cost which is incidental to bring the machine it into present condition, like repair, overhaul, etc. So the cost principle says an asset is recorded in the books of account at the price at which it is acquired. Matching concept. The matching concept is a very important concept. It says that for the determination of net profit from business, all costs which are applicable to revenue of the period should be charged against that revenue. For example, we have incurred an expenditure on insurance for a year and we will get benefit of that insurance in another area. So the entire cost of the insurance product will be proportionally distributed between the 2 years so that we can get the actual profit. So as per the matching concept, while determining the net profit, all costs which are applicable to revenue of the period should be charged against that revenue. This is the reason why we deduct closing stock from the sale, because the closing stock will be the cost of next year. It is not a cost of present year. And the last accounting principle is dual accounting principle, which says that every transaction affects at least two accounts. If one is debited, any other account must be credited. This is an also a way of saying asset is equal to liability plus capital. This is the most important concept of accounting. It it shows that there are two sides, one is debit and credit, and every transaction has at least one debit and one credit. So thank you here, and here we end this topic. Thank you for being with me, and like, subscribe and share my channel. Thank you from Figure It Out with Rajat.